if you know someone from your friends who says he's a business angel, from a statistical point, the chances that he loses his money are probably 80%. If we see the facts, I just need my clicker, I'm sorry. Yeah, here's my clicker, here we go. If you invest in early stage or later stage venture, the facts over 30 years are pretty clear. This is actual data from 2013 and describes over a period of 33 years the performance after cost for early stage investments, later stage investments. And you see that private equity, later stage, and mega is making high returns. We talk about VC on the next panel. This panel, it's great to have Patrick, who's the Deputy CEO of Hellman and Friedman here on the panel to talk about. And Patrick, I think it's a very impressive portfolio, what you're handling. And what we found most interesting, that's also something I wanted to talk to you in the beginning, was the acquisition of Scout24. Because at the time when the Deutsche Telekom decided to sell a major part in it, everyone, when the transaction was done, everyone said, that is a transaction on the brick. I mean, how can they make money? And it turns out, 2-3 years later, that you made a great return. Do you want to tell us how that worked and how you see the transaction?
Well, I'm Irish, so a little bit of luck helps. But we, I think one of the things, so private equity, that previous page and later stage, we're trying to take less risk by definition because we're investing in existing businesses. So we can analyze it, we can see what the profitability is of a business. So a lot of what we're trying to do is to try and figure out how fast can it grow, what are the barriers to entry, how will it perform over the next 5 years. So we, by definition, are in a less risky stream than pure venture capital. So that's a great place to be from our perspective and from the perspective of our investors. We then have a long history, and I have 25 years at Hellman and Friedman, where my first investment was buying John Fairfax newspapers down in Australia, then investing in Axel Springer in Germany, investing in lots of print media, and understanding about the value of print classifieds as sort of the rivers of gold. So we sort of had this insight as traditional media businesses started to get eroded as the internet came up, and we switched our attention from investing in traditional media to more digital and internet media. So things like Scout24 or Getty Images, where we could sort of see a new opportunity. And one of the big observations about Scout was just how cheap it was and how much value is delivered for the customer by going online relative to print. It's about a tenth of the cost. You can actually measure what you're doing. It was just a much, much more efficient way of doing it.
Just to understand, you have been driving that process to acquire that company, right?
Correct.
I still have been on the board.
Yeah.
So, I mean, in that company, probably tons of people looked into. And when you say it was cheap, how did you find it out in the process?
We saw the product as cheap for the customer and delivering great value.
Okay.
Then we said that's just a big insight, and we see a lot of opportunity to develop the product and deliver more for the customers and get paid for it. So that was an insight we had about the business. We then had an insight that the business could be run more efficiently. And that meant focus, which was a big thing that we believe in the way that we run our own business. So between the time we signed and the time we actually closed and actually transferred the money to Deutsche Telekom 3 months later, we had sold 300 million of our existing businesses to get down to the core auto and real estate business. We then
so you sold the dating business.
We sold the dating business,
international parts. You really
business.
focus on the German-speaking market.
Exactly. And let's do two things, and let's do them really well. We then we had a great management team at Scout, but we had a relationship with a gentleman down in Australia who had run a very successful publicly traded real estate classified business, and we partnered with him to bring some of his ideas.
Means you fired everyone who was in the management team before.
We enhanced the management team.
Okay.
And introduced we basically took a playbook, which was proven from Australia, and it looked like Scout two years before. So sort of those insights around the value of digital classifieds, the opportunity to streamline and focus the business, and a belief in our operating plan allowed us to pay 20 times EBITDA, which people thought we were nuts, and often we are, but we happen to be right.
And today, at the IPO with $3.5 billion, you made 3x?
3 times our money in 18 months. We haven't monetized it yet because we've sold some, but we haven't sold everything, and we continue to believe in the future of the business.
Okay. I don't know, Matthias Döpfner, is he already here? He will be here in an hour. Springer was very intensively looking into the asset. That is, everyone knows in Germany who is in that business. Do you think a CEO of a listed company has a competitive disadvantage because he has to present every quarter figures where you can acquire and you can make your choice when you exit the company or IPO the company, not delivering but not showing every quarter numbers? Is there a strategic disadvantage for listed companies to acquire those kinds of large and profitable assets?
I think that the private equity business model, in this example, Matthias's market cap was probably $3 billion. So for him to go and do $2 billion on a single investment, I don't want to say that's a bet the company, but that's a huge bet. I'm managing an $11 billion fund, so for me to put down $1 billion of my own equity into Scout, that's 10% of my fund. It's risky. I can't get 2 of those wrong, but I can certainly adjust the risk. The governance model of private equity, which allows us to be extremely performance oriented, and we have. I don't know, I've been doing this 25 years. I've probably made 50 investments. There's 50 years of accumulated history just with me in terms of, a playbook, right? So we're in the business of buying and selling businesses more than corporates. And for sure, the reporting and the public demands, make it more difficult.
But that means, how many companies have double-digit billions valuation at the moment who could acquire those large assets? Probably very few on the planet, right?
Well, it's today's a very competitive environment, so I would say that I would say that private equity continues to be extremely active in enterprise values between 2 to 8 billion in the large end of the market, and that continues to be a very, very robust area. And think about the model of private equity, which is I get money locked up for 6 years. I can spend it on anything I want, except for oil and gas and real estate. Every private equity firm that looks like us, it's the same thing. It's sort of crazy, right? So you can actually go and buy anything you want. You report to your investors once a year, and they can't really fire you. You think about the global financial crisis and how few private equity firms went out of business. It is the one business with the highest barriers to exit I think I've ever seen. It's sort of stunning.
Yeah, Patrick, if you look now into new ideas, what are you as a company being interested in? What are the sectors you look into? What are the topics you really are, what do you think the next big thing is for your company?
Right, so I would say that the shortage in the world is growth. So if you think about what's growing, it's in the tech landscape. And we think about tech from vertical market application software over to sort of internet. And we're deeply focused on finding businesses in the tech area that are of scale for us, where we can help the company achieve better performance. Maybe that's moving to the cloud. One of our big themes at the moment is mobile and speech recognition. So we just bought a business called Genesis, which is a call center software business. We bought that for about $2 billion with another private equity firm. 3 weeks later, we took a company private in America called Interactive Intelligence. So this is all a play on call center software. And it's a huge investment about moving this business to the cloud and improving their voice recognition, which is a play on mobile. So it feeds directly into, we're buying lots of stuff online, but you still need to speak to people.
And do you have a global perspective on the targets? Is it North America?
So we would have
if you see your funnel, where you really go and do due diligences, where are most companies? Which section?
It's probably 75% North America, and then 25% would be rest of world. We would look at our addressable universe as probably 1,600 targets. Of the 1,600 targets, we would then stratify them by quality and what we would say is actionability, and that would probably bring that down to about 600. We then divide those up by sector. Maybe it's internet security software, maybe it's digital media, and maybe it's data and analytics. we appoint somebody, we give them a list of names. So we actually sort of run it a little bit like a software sales business. And those people go out and they learn the industry and they learn the sub-vertical, because it's not so much technology that's important, it's the sub-vertical of
Absolutely.
security software.
And are you doing that with a team of? How many people do you have on your team working?
We do it with a team of 35 professionals. And the way we make that work is that we're trying to make scale investments. So we're not doing the real venture capital stuff. So we're trying to make an investment of 500 million of equity up to 2 billion.
Okay.
And then, of course, we can use leverage on top of that.
Okay, if we just jump back to the question of speed recognition. I mean, you have the big elephant Google in the room and Amazon. They spend billions probably over years on that topic. If you see the companies, how do you evaluate that Google is there, that an Amazon is there, that they build products, that they build software? How do you evaluate those big animals if you see a business model that is close to them?
Well, we spent a lot of time trying to assess the competitive position of the business and the durability of it, and the demonstration of things like pricing power and barriers to entry, and customer checks. And we're typically looking for technologies that are deeply embedded in the workflow of a business. That's not to say that the Google algorithms have not impacted our investments. So when Panda came along, and we had a couple of consumer-facing internet businesses, one in the travel area called Web Reservations, one in the US called Internet Brands, relying on natural search. Those had a meaningful impact from the change in the Google algorithm. So we're mindful of that, but we're trying to find businesses, Stefan, that are embedded enough in the workflow that it's not going to be obsolete, but we need to adapt.
Okay. Would you say that still the best ideas are come out of Silicon Valley? Or if you say you make the majority in North America, is that Silicon Valley? Is that New York? Is it Austin, Texas? How do you define the innovation hubs of the world if you see your business?
Look, I've chosen to live in Europe, right, and raise my family in Europe. I love Europe. This is where I've chosen to be. But a lot of the innovation comes from the U.S., and so a lot of what we do is across the U.S. But then we try to find those trends and find them in Europe. But digital classifieds, I mean, that has not been as successful in the U.S. as it is in Europe. When we think about something like that, we think about some of the data and analytics business that have come out of Europe. So I think it really depends on sort of the sector that you're talking about, but by and large, I think more opportunity because the ecosystem is bigger, the funding pools are bigger. I think the culture of risk-taking is much, much bigger in America than it is typically in Europe. That's changing.
Yeah, but that would be my next question. I mean, you are so long in the business. If you would evaluate the way how Europeans are now taking risk, or Chinese, has that changed over the last 5 to 10 years?
Yeah, sure.
And for you, is it if you see the companies you see, how important is that fact really taking big risk if you evaluate a management team?
Look, I mean, the culture outside North America has been one of cash and carry. So people were very hesitant to take risk in the form of equity in the business. And so probably for the first 10 years of my career, explaining equity to European managers, and British, if they're still part of Europe today, I don't know, was a lot of my job. It's much more common that they would understand how an equity program would work. They might be willing to take a little bit less risk. But the one thing we found, Stefan, is if you go back and look through all of our data, those investments where the management team have taken more in the form of equity and reinvested more of their own proceeds into a deal, they've done better.
Return is.
They've actually done better.
And for you as well. If you compare yourself to strategic investors, how do you see strategic investors if you are in competitive situations? Do they have an advantage because they have special deep skills or media power, like a media company, or is it just at the end of the day valuation and money, if it comes you acquiring companies?
Well, I think they would have much better advantages. I think about DoubleClick, which we owned, and we sold to Google, and we made a terrific return, and we sold it at, I don't know, something like 30 times EBITDA. I think they've taken that business, I'm guessing, from probably 100 million of earnings when we sold it to 3 billion. Yeah. So the ability of them to plug it into their network had much greater network effects. So I think strategics, when they find the right asset, have much better synergies. I think our advantage is that we have the ability to move with speed, and we have the ability to find more things that fit.
probably more brain power, probably open thinking. When you said, we saw the customer very differently at Scout.
Yeah.
I mean, we had lots of discussions, but very few people talked about how can you increase the price of the whole subscription ecosystem.
Right.
So to think neutral about that, that is something, at least here, you did differently. Just one question, if the interest rate goes up by 200 or 300%, we are now, in Trump times, European bank might also reduce our low interest rate scenario, which we have here, and increase. How do you see that? Has that an impact on your business?
It's going to have an impact. Think about this. The entire private equity industry has been built on a 30-year decline in interest rates. That's been my career, which means multiples have gone up. So I think it'll be a change.
What will happen? I mean, just if it goes up by 200-300%, which could be in the next 24 years.
I think you'll see a compression in asset values. You have to. You have to. And this talk about Trump disallowing interest deductibility, that should meaningfully impact the private equity and low leverage buyout business.
But that means, if that happens, we might have some great times for strategic buyers who have enough money and not as debt as you have on a PE transaction. Correct. To acquire those assets cheaper than people thought 2 years ago.
Correct.
Okay. Let's talk about politicians. You told me when we phoned yesterday that you had a dinner with President Obama. Do you think he will change to private equity?
I have a very boring life, but in April I got a call at about 5:30 p.m. on a Saturday night inviting me to a dinner in London with Obama and Cameron and 5 other people. And so I show up at the dinner, and it's Obama, Cameron, and then it's a bunch of British media types and me. So then I understood the term the British have of being called the squeeze. Somebody had clearly canceled. I got thrown in. It was a Saturday night roundtable dinner. It was when he came to London to do the whole Brexit talk, and it was a wide-ranging conversation about stuff. And he was delightful and charming and intelligent and tough. And I gave him the pitch on private equity, and I'd be surprised if he takes it up.
Okay. You think he rather goes, he's very well educated, but not from the business school?
Yeah. He has not earned a lot of money in public service. So I wouldn't be surprised if he figures out a way to do that, and he should. But he can do probably more than the next Scout 24. Okay. My last question goes on the question of are we in a bubble? Uber, 8.71 billion. Airbnb, 3 billion. We had this morning a presentation by Scott Galloway, who showed us that one user at WeChat has a valuation of $1 million. Are we, just what you said with interest rising, I think it's clear something will happen. Are we in a bubble that might bust soon? Well, we never know where we are. What we know is we're 8 years into an economic expansion of the average economic expansion the last 5.5 years. We know we have a new administration in America which has some stimulative growth policies, as well as some things that might be considered to be restrictive to global growth. So, I think we are in a period where, liquidity, there's a superabundance of capital, and it's easy to raise money, and it's easy to put money to work. But we're clearing a period of sort of uncertain times. So while risk capital is on, I think it's a time to be observant and cautious.
And just to add a last question, many people hear what I felt yesterday in the discussions. There's a lot of uncertainty about Trump and how his change in politics might change the tech industry globally. What is your view on Trump's, what you have heard so far? How do you see it as an American who lives in Europe?
I'm nervous.
You're nervous?
Sure.
I think everyone is here.
Yeah.
Thank you very much.
Thank you.